Section 5.2 Understanding Dividend Payout Ratio, Dividend Stability and Predictability. Consistent dividend payments play a crucial role in attracting and rewarding income-seeking investors. They provide a steady stream of cash flow to shareholders and can be a signal of a company's financial health and stability. The dividend payout ratio is a key metric in assessing the stability and sustainability of dividend payments. Here's an analysis of the importance of consistent dividend payments and the role of dividend payout ratio in assessing stability, investor confidence and income stability. Consistent dividend payments instill confidence in investors, particularly those seeking a reliable income stream. Investors rely on dividend income to cover living expenses, reinvest in other assets, or achieve specific financial goals. A consistent dividend payment history demonstrates a company's commitment to shareholder returns and financial discipline, which can attract income-oriented investors who value stability and predictability. Long-term value proposition: companies that consistently pay dividends and maintain a stable dividend policy can signal their confidence in future cash flow generation and profitability. This can attract long-term investors who prioritize sustainable and growing income streams. Such investors often value the stability of consistent dividend payments as they align with their investment goals and help create long-term wealth through reinvestment or compounding returns. Financial health assessment: the dividend payout ratio is a useful metric in assessing a company's financial health and its ability to sustain dividend payments over time. A lower dividend payout ratio indicates that the company retains a larger portion of its earnings, which can be reinvested in the business, used for debt reduction, or allocated for future growth opportunities. A lower payout ratio generally suggests a greater capacity to weather economic downturns, invest in research and development, or fund capital expenditures. On the other hand, a high payout ratio may raise concerns about the company's ability to maintain dividend payments, especially if earnings decline or face volatility. Dividend payout ratio as a stability indicator: the dividend payout ratio serves as a key indicator of dividend stability. A lower payout ratio indicates that the company has a larger buffer to absorb fluctuations in earnings and sustain dividend payments even during challenging periods. Companies with a history of stable or gradually increasing dividend payout ratios are typically viewed more favorably as they demonstrate a commitment to balancing dividend distributions with long-term financial stability. Dividend policy alignment: the dividend payout ratio also reflects a company's dividend policy and its alignment with strategic objectives. Some companies intentionally maintain higher payout ratios to distribute a larger portion of earnings to shareholders, signaling that they prioritize returning capital to investors. Other companies, particularly those in growth industries or early stages of development, may retain a larger portion of earnings to reinvest for future expansion. Assessing the dividend payout ratio in the context of a company's industry dynamics, growth prospects, and capital allocation priorities is important to understand its dividend stability. It's important to note that while a consistent dividend payment history and a lower payout ratio can indicate stability, they do not guarantee future dividend sustainability. Investors should conduct thorough fundamental analysis, evaluate the company's financial statements, cash flow generation, and overall business outlook to assess the long-term viability of dividend payments. Additionally, considering other factors such as industry trends, competitive positioning, and management's track record can provide a more comprehensive evaluation of dividend stability and the overall investment opportunity. Economic cycles and market conditions can have a significant impact on dividend payout ratios. Here's an analysis of how these factors influence dividend payout ratios: economic expansion and bull markets. During periods of economic expansion and bull markets, companies tend to experience improved profitability and cash flow generation. This often leads to higher earnings, providing a solid foundation for dividend payments. As companies generate more profits, they may increase dividend payouts, resulting in a lower dividend payout ratio. This is because a higher portion of earnings is distributed to shareholders in the form of dividends. Economic contractions and bear markets: during economic contractions and bear markets, companies may face financial challenges, reduced earnings, and cash flow constraints. In such periods, companies may be more cautious about dividend payments to preserve cash and strengthen their balance sheets. Consequently, dividend payout ratios may increase as companies maintain or reduce dividends while their earnings decline. A higher payout ratio indicates that a larger proportion of earnings is being distributed as dividends. Industry and sector variations. Different industries and sectors respond differently to economic cycles and market conditions, leading to variations in dividend payout ratios. Industries with stable and non-cyclical business models, such as utilities and consumer staples, often maintain higher dividend payout ratios, even during economic downturns. Conversely, industries that are more cyclical or highly capital-intensive, such as technology or manufacturing, may have lower payout ratios, especially during economic downturns when earnings are more volatile. Cash flow considerations. The availability and stability of cash flow influence dividend payout ratios. In times of economic uncertainty or tight credit conditions, companies may prioritize conserving cash to manage operational expenses, debt obligations, or potential investment opportunities. This can lead to higher dividend payout ratios as companies retain more earnings rather than distributing them as dividends. Investor expectations and market sentiment. Investor expectations and market sentiment can also impact dividend payout ratios. During periods of market optimism, investors may have higher expectations for dividend growth and may reward companies that increase or maintain their dividends. In response to investor demand, companies may adjust their dividend policies to meet these expectations, resulting in lower payout ratios. Conversely, during market downturns or when investors prioritize capital preservation, companies may be more conservative with dividend payments, leading to higher payout ratios. Regulatory and legal constraints. Regulatory and legal constraints can influence dividend payout ratios. Some jurisdictions impose restrictions on dividend distributions based on solvency, capital adequacy, or legal requirements. Companies operating in regulated industries, such as financial services, may face specific regulatory constraints on dividend payments, leading to variations in payout ratios. It's important to note that the impact of economic cycles and market conditions on dividend payout ratios can vary across companies and industries. Investors should consider a company's specific circumstances, including its financial health, industry dynamics, and strategic priorities, when assessing dividend payout ratios. Additionally, a comprehensive analysis of a company's financial statements, cash flow generation, and overall business outlook is necessary to evaluate the sustainability and potential changes in dividend payout ratios.